Good afternoon. Welcome to our University Credit Union webinar, Empowering Your Financial Journey. My name is Megan Sterling, and I'm joined by my colleague Julia, and I'll let her introduce herself.
Hi, everyone. My name's Julia. I'm a senior growth officer here at University Credit Union. I've been here about 2 years, and I'm very excited to be here today. My favorite part of this job is doing these financial webinars and literacies, so we're excited to be here.
Thank you, Julia. And I'm also a senior growth officer here at the credit union and been here for a little under 2 years. And I as well enjoy doing these webinars and sharing financial literacy with all of you. Julie and I are both certified financial counselors and help members every day on their journeys to gain wealth. Today, we're going to talk about investing to achieve your goals. And today, you're going to learn practical ways to save. You're going to discover ways to tailor your investment choices to achieve your goals. And finally, you're going to gain some insight into why a one-size-fits-all approach doesn't always work when it comes to financial success. But before we get into all that good stuff, we are going to talk a little bit about University Credit Union. And for the sake of today's webinar, we are going to use the Q&A. I encourage you to put all of your questions in there. We have people monitoring that, and they will get them answered for you. And if you're a member, please let us know. And thank you for being a member with us. So we were founded on the campus of UCLA by the staff and faculty back in 1951. So we've been around for over 70 years. And today we're not just UCLA, we are all of the UCs are in our field of membership. We have hubs at UC San Diego, at Davis. We also have many private schools like St. Mary's, where Julia's from, and LMU, and we are also out of state. And our newest addition is Abilene Christian. We were founded by that community, the university community at UCLA, and it continues to be who we focus on. So a lot of people ask us, what is the difference between a credit union and a bank? And before I tell you the difference, I want to tell you the similarities. For one, we are both financial institutions. We have very similar products. We both have savings, checking products, loan products, mortgages, credit cards, and the list goes on and on and on. We also are both federally insured. Banks are insured by FDIC and credit unions are insured by NCUA. So your money is definitely safe at both of them. But what makes a credit union different? We are not for profit. So we are member based. We are owned by our members. We do not pay shareholders. So the good news for you is we're able to return those savings to you in the form of lower fees on loans, auto loans, mortgage loans, credit cards, and then higher rates on savings type products. So there are a lot of benefits to being part of a credit union. Credit unions are part of a co-op. So if you belong to the credit union and you look on the back of your debit card, there's a little triangle on there. You can go to many credit unions and use their ATMs. About 98% of them have that triangle symbol and use their ATMs at no charge, no fee to do that. And then my favorite thing about being part of a credit union is we are community focused. So we give these webinars free of charge. We give free financial advice. We do community give back projects. So we're all friends in the credit union world that is out there. A little bit more about UCU and who we are. We started with staff and faculty, but now anybody can be a member of the credit union, from students to alumni to retirees. And once you're a member, you are a member for life. We live by the following value propositions that were founded by the university for the university. We give unbiased, conflict-free information. You can get that information whether you're a member or not, and you can schedule an appointment virtually, you can scan that QR code, schedule some time to meet with us, and get your questions answered. We work with members all day answering different questions. And believe me, there is no question that is not necessary to get answered. And finally, we have a 5% rate guarantee on the majority of our products, not all products, but the majority of them. So there is a lot of great things to being a member of a credit union. I'm now going to turn it over to Julia, who's going to get into building your portfolio.
Absolutely. Thanks, Megan. And just a quick pause, if there are any questions about UCU or credit unions, go ahead and throw those in the Q&A. We're happy to get those answered before we transition into more of the meat of everything. And our chat monitors will help answer those for you if you throw those in there. So today, what we're going to be covering is how to build your financial portfolio. So what that looks like is starting with a strong foundation. Knowing the building blocks before you just jump straight into more maybe advanced or investments, stock market is just making sure you have a good financial foundation first. And in order to strategize properly, it's important that we understand your goals. So why are you saving, or why are you trying to build your wealth? Is it for family? Is it for a house you want to buy? Is it retirement that you're strategizing for? So really understanding those goals and structuring them in a way where they're more tangible and more easily achievable. And next, we're going to talk about how to make those informed investment choices. There's a lot of noise out there. I'm sure you see it on social media, online, about this investment being the best or this being the right strategy. But like Megan mentioned at the start, it's not a one size fits all. So it's really about getting informed and making the decision that's going to suit your goals specifically. And then lastly, how do we stay on track? Our finances are never one and done. So it's something that we want to check in on, maybe weekly, monthly, quarterly, annually, whatever works for you, but how to make sure we stay on track with our goals. And if we do get off track, how to course correct and come back to it and make sure that we don't just fully walk away. It's okay to have a cheat day and a diet. It doesn't mean that we give up on it entirely. So when we build that financial foundation, there are a few things we want to look at first before we get into investments. First thing would be paying off our high interest debt. So before you go and invest, it's wise to pay off any high interest debt you might have. This could be credit cards, this could be student loans, this could be a personal loan. But essentially, if we have money that can pay off high interest debt, it's better that we get rid of that debt before we go and invest it, while we're still trying to pay off high interest debt at the same time. Ultimately, that gain we're getting might be canceled out by high interest debt that we're paying on the other end. So one of our first priorities in that foundation is paying off that debt. Next would be building an emergency fund. We want to ensure that we have funds to cover any sort of emergency that could pop up. It could be a medical bill. It could be that your roof caves in, God forbid. Could be you have to replace all four tires on your car. We want to make sure we have money that's liquid, that we can access easily in case of an emergency, versus if all of our money is tied up in the stock market, or maybe it's locked away in a certificate, we're not going to be able to access that money for something that could happen today that we might need it for. So building that emergency fund is very important as well. And that comes along with setting a budget. We have to determine how much we can afford to save and set aside, how much we can afford to invest, by figuring out first how much income is coming in every month and how much is going out. What are we spending our money on? What are those fixed expenses that we have to make sure we have money for? And then what about fun money? We need to have some stuff set aside to treat ourselves. We don't want to go crazy just spending on essentials only. We want some money to go out with friends and family. Maybe it's getting a pedicure, buying a new set of pots and pans, whatever it might be, having a little fun money every month as well. And lastly is considering retirement. So as part of that investment portfolio, we want to be planning for retirement. Are you already contributing to maybe a 401k or an IRA? Because that's money that's being invested and set aside. So don't discredit that. That's money that you're already building towards your future wealth. So these are all sort of those first steps in the foundation that we want to make sure we have accounted for before we go on and invest. And next is setting those goals. So when you go to invest or when you're going to set up that financial foundation, it's important to understand your why. A lot of times when I meet with folks about their financial picture, the goal that they have is saving money. Um, and they don't have much figured out beyond that. It's just this general vague, I want to save money, which could really mean anything. That could mean I'm saving $10 this month, and technically I've reached that goal, but it's probably not what we mean. So we want to turn those goals into more SMART goals. They need to be specific, measurable, attainable, realistic, and timely. So if we take that goal of wanting to save money, we can make it more specific of saying, I want to save to buy a house. Now I have a specific why behind my goal. I can make it measurable by putting a timeline on it, by putting a dollar amount to it. So I want to save up $200,000 for a down payment. And I want to buy that house in 10 years. And all of a sudden, we have more of a tangible goal. It's not this vague, mysterious thing kind of floating or looming in our mind. It's something where we can say, okay, if I have 10 years by 12 months, how much money do I need to put aside every month for 120 months to reach that goal? So all of a sudden, it becomes more attainable, and it becomes a more realistic goal. And ultimately, we do want to pick something that's within our means. If your goal is to save like $1 million in the next 2 years, that might be a little difficult. And it's hard to sort of stay on track and feel confident about your goal if it's really lofty and you're just not making progress towards it. So it's okay to start small. There's no goal that's wrong. Like we said, it's not a one size fits all. Your goals are going to be different than the person next to you. All that matters is that you're creating those goals in a way that is attainable for you and understandable and sort of motivates you to get going on that goal. So there's two kinds of goals. You can have short-term goals and long-term goals, and you probably have a mixture of both. And we should be saving and working towards both of those goals all at the same time. So you can have things that happen maybe within the next 3 to 12 months, we would consider a short-term goal. That might be something like, I need to buy a new car before the end of this year. My car is, on its last legs. It could be a vacation you want to take this summer, in the next few months that you're saving up for. Maybe it's a new laptop for the start of next school year. Those would be short-term goals that we want to be working towards. And longer-term goals might be paying off my student loans. That could be buying that house. That could be retirement. Anything longer than a year from now, we would call a long-term goal. And they're both important. They're equally as important. And so we want to be working towards both, having a strategy for how can we set aside money for the short-term stuff, but maybe using investments or other vehicles to prepare us for those long-term goals at the same time.
Thank you, Julia. And I had a quick question to ask you before we go on to our next topic. You talked about the emergency fund. How much would you say should be in an emergency fund?
That's a fabulous question. Rule of thumb, try to have about 6 times your monthly essential expenses saved up. So not your full budget of your discretionary money brought in there, but just the essentials, your rent, your bills, your gas money, your groceries. Take that number in a month's time, multiply it by 6. And that's kind of a good starting point, a good financial goal that you could have is trying to reach that threshold.
I love it. Thank you.
Mhm.
So that was a lot to unpack that she shared with us. And that leads us into this, which is your money personality. But let's define what is your money personality? It really is your character traits, your values, your attributes, and your behavioral patterns regarding money. Simply how you perceive and use the money that you get. So, how do you figure out what your money personality is? There's a couple things you can do. One, list all the products and services that you spend your money on. Or even easier, just keep all your receipts from that last month. And at the end of the month, look, where is my money going? What am I doing with it? List ways that you're a good spender and list some changes you would like to make in your spending habits. In short, get real with how you use money. Now, we get our money personality from a lot of things. Mostly we get it from how we were raised, especially when we're just starting off. Maybe we are a student and we've never really had to worry or handle money. But as we get older, it changes. Our culture may shape our money personalities, society, our friends, the economy, our jobs. So your money personality is constantly evolving. So once you've done the exercise, you can see where you fall on the chart here. And you can see there's 8 different types. There is no type that is wrong. And you're probably not 100% of one. Like, for example, the first time I saw this, I saw the word hoarder. I was like thinking about that TV show Hoarders, thinking that can't be a money personality. But when you read it, that's the person who likes to save, budget, and prioritize. So it's okay, whatever you are. I always say my money personality is 70% risk avoider. And I go for the sure thing. I want to know what it is. I'm 10% hoarder and I'm 10% spender. I work hard for my money and I want it, of course, to go to my goals that I'm setting, but I also want to have a little fun money to spend every month. I always want to be a risk taker, but it's just not me. I just can't take even $100 into a casino and drop it in there. It's just too risky. I'd rather be the risk avoider in it. So we all have different personalities. None of them are bad. None of them are, don't get hard on yourself with this. Get real with yourself. And I always tell people if you're in a relationship, talk about your money personality with your partner and make sure that you understand each other, because this is an important topic that is out there, especially when you're starting to invest. So why invest? There's so many great reasons to invest. And these can be directly tied to your goals. We talked about retirement as a goal. That's a great reason to invest. You are with retirement, you'll ensure financial security and independence later in your years. What a wonderful feeling to be able to retire. And there are so many great ways to go about doing that. Build long-term wealth, grow your assets over time, and create financial stability. You work hard for that money, let that money work for you. And that's what investing does. It helps build long-term wealth. And we're going to talk about different things that you can invest in. Achieve your life goals. Now, we put a few down there: buy a home, education. It can go beyond that. Fund those major milestones that you want out of life. And that's different for all of us when it comes to that. And benefit from compound growth. Reinvest those earnings to accelerate financial growth. That's my favorite one, watching your money grow and you're not even working for it. You've put it in something that's growing and it's strong. And over a period of time, you can see some really strong growth from the reinvestment strategies. Okay, so let's talk about some common investment options that are out there that you've probably heard of. The first one is stocks. Stocks are basically you have shares of ownership in a company. When you buy a stock, you become a partial owner of that company. If the company does well, the value of your stock increases, you can sell it, you can make a profit. So if you bought Apple stock in the early 80s and you still have it, you're doing really, really well with that. If the company struggles, then of course there might be a loss for that. There are a lot of ways to watch the stock market. You may enjoy watching it. I do. I love to have it up every day. There's a couple of big indexes that people watch. One is the Dow Jones Industrial Average. That takes the 30 leading industrial blue chip stocks and watches them every single day and puts out how they are producing. Some of the companies that are on that are Amazon, Nike, Apple, American Express. Today it's pretty flat. It's down about 1.5 points from yesterday. And of course, the stock market is cyclical. So there are good days, there are bad days, but it does average out. You can also watch the S&P 500. That stands for Standard and Poor's Composite Index. That covers market activity for 500 stocks. Again, it's down about 1% today. And then, of course, there's the NASDAQ, and that is a very fancy acronym that stands for National Association of Security Dealers Automated Quotations, but they refer to it as the NASDAQ. And it monitors fast-moving technology companies that are out there. So that's stocks, and you can follow that on the stock market. Bonds, when you invest in a bond, you basically lend your money to an organization. Once the bond is issued, it has a specified maturity date at which time the principal will be repaid. Um, and they're always issued at a particular interest rate. So you can they're a very safe investment when you go into the bond market. For example, if you buy a 5-year 6% bond issued by Home Depot, you're lending your money to Home Depot for 5 years at an interest rate of 6%. And then at the end of that, you usually get paid out in 2 equal semi-annual installments. So bonds are a very safe area to go into. And then we have, and historically, stocks return about 11%, bonds about 5% in the market. That's just an average. It doesn't mean it's going to do that. It's just historically over time. Then we have what's called ETFs, which stand for exchange traded funds or index funds. So what this is, they take a variety of stocks, bonds, commodities, and they wrap them up into a fund that they list on the exchange so that everyone can use it. It's an investment fund that tracks a benchmark index basically, and but they're safe. It's like a mutual fund because it's got multiple things in it, but it's stocks and bonds and commodities that go into those. And then finally, there's cryptocurrencies. This is the newest investment product we're going to talk about. This is digital money that exists online. The biggest one, of course, is Bitcoin that is out there. And think of it like virtual tokens. People buy, sell, and trade them just like stocks or cash that are out there. This is a fairly new one. These are the big investment options. Of course, there are things like real estate you could invest in as well, but we're not going to talk about that one today. Again, put your questions in the Q&A about these. And I'm going to switch it over to Julia. She's going to talk about diversification.
Thank you, Megan. When it comes to all these different types of investments, it's important that you diversify. And you've probably heard that word before, but essentially diversifying that portfolio means that you're reducing risk. If you put all your eggs in one basket and the stock market crashes, you lose all that money. Versus if you use a few different types of investments, you can ensure that even if one category is having a bad day, not all your money is stuck in there. There are other places where that money is growing and earning, regardless of if there's one bad day for one type of investment. So it reduces risk when you diversify without sacrificing the returns. It means that you're ensuring that you're going to get returns one way or another from one of these places. Another type of diversification that can help is doing some international diversification. So essentially investing globally can provide you access to more diverse markets. So your money is not solely waiting on one country's economy. If our economy is struggling, it means that if your money's invested elsewhere, then that economy is doing well. Again, you've diversified, and so it reduces that risk. You can still be earning regardless of what's happening in one location. And then lastly, to diversify adequately, it's around 40 stocks is considered a well-diversified portfolio. Managing that risk, it's not all in one stock, but you have a nice balance of about 40. It'll give you a nice average where you should get a good return regardless of a few bad days or a few stocks that, not always are going to do what you think they're going to do. So that's why diversifying is important. And ultimately, it's good to seek professional advice. So, it's awesome that you're here today and you're interested in wanting to learn more. When it comes to investment services, it's important to look for professional advice. Talk to people that know more, that do this every single day, that have seen a lot of different examples of it. If you were going to go build a house, you probably wouldn't go build it yourself. You would hire a contractor and a plumber, an electrician, and people that specialize and are experts in those fields. So it's the same thing with finances. You can work on some personalized financial planning. So you can create a plan with a professional that suits your specific goals. It's one thing to do research and watch videos online of what other people have done, but it's a totally different story to meet with somebody who can hear your goals. It's sort of like a doctor, prescribe what's going to work best for you based on what you're trying to achieve. So that could include some expert investment advice. Talk to people who are specifically in the investment space. We have a partner called Copper Financial. You can see their logo on the top right there. Totally free service to meet with them. If you're a member with us, we can refer you there. Let us know in the chat and we can get you all set up. Our amazing investment advisor, her name is Lucy, and we can get you set up to meet with her and sort of go over this portfolio and how to diversify and fit what your risk tolerance is and make that plan that's going to feel right for you. And then beyond that is also just doing a more comprehensive financial management. It's not just investments like we talked about before. It's making sure that your budgeting is correct, that you're able to set aside money every single month for whether it's investments or that emergency fund, planning for taxes, working through debt management. If you have credit card debt or student loans that maybe you're a little overwhelmed by or swamped in, that's part of that full financial picture. Your full health has to be well-rounded. So we want to look at all those areas. And those are things, budgeting and debt management, that we can work with you on personally. And that's where you can go to our website. You can book those consultations with myself and Megan and other financial certified experts in our team to go over some of the more day-to-day comprehensive financial management. And lastly, it's important have emotional support and discipline here. Money is an emotional topic. When the stock market has a bad day, you might feel very upset. You might feel scared. You might want to pull that money out. So it's important to have guidance and help for those impulsive decisions. When you are, wanting to do an impulse purchase, it's important to have strategies to sort of prevent you from doing that, stay on track with those goals. And so it really is like full counseling. It's not just about money. There's a huge financial component to it, especially when our money's tied to goals that are, hopes and dreams and things that we really want to achieve. So emotions are a big piece of this as well.
Thank you, Julia. And professional advice is the key to all of this. We partner with Copper, and Lucy is great, but I do want to let you know that as far as tax advice, we are not tax advisors at University Credit Union. So we always advise you to seek out a tax professional when you are doing investing and any type of financial thing. Talk to your tax professional about that. But starting small, it is okay to start small. You do not need a lot to begin. You can have as little as $5 a month to start investing. A lot of people do investing online on their own. Be very careful with that. I mean, it's very popular. I know with younger people, there are a lot of fees that go with that. And if you have any large sum of money, though, I always advise you use a professional to get the correct information. Use automatic transfers. That's very important as well from your account so that you are able to track it. One place you may want to start your investing journey is start with a high yield savings account. Now, every financial institution has some sort of high yield savings. A basic savings account pays you less than 0.1%. And so that's not very much that your money is making for you. Look for a high yield savings. But as I always say, read the fine print. And it can be very overwhelming, all of this information, the terms that they use. For example, APY stands for annual percentage yield. Our high yield savings at University Credit Union pays 3.5%, but you must have $2,500 minimum balance to earn that dividends. If you are, and that needs to be new money coming into University Credit Union. Many financial institutions will have that on there. Now, I always say, this is the part sometimes where it starts causing anxiety for people, and the fine print is overwhelming. I know you've probably seen all those fine prints on things that you sign up for, and you're like, "Oh, I don't read it." I go to the bottom and hit acknowledge. Um, Read them. And if you don't like to read them, let us read them for you. Bring us the fine print. We'll help you decide, is this the right product for you? The nice thing about a high yield savings is this is a liquid account, so you can get these funds out at any time. We actually drop the dividends in monthly for you. So at the end of the month, you get a little dividend, which is really nice. But the other way that you could start investing is also in a certificate of deposit. Sometimes that's called a CD. We have one that pays 4% APY for 6 months. So, but that money is frozen. So that is the difference between a high yield savings and a certificate of deposit. But both great places to start. If you don't have an emergency savings fund, but you have some extra cash, put it in a high yield savings and it will start earning for you and making good money to start achieving that goal. Take action today. Review your goals. What are they? I always say the goals and the budget are something that you should be looking at. It depends on what your money personality is. I look at mine every month. I still do. And, but you know, if you're feeling really good, maybe it's a quarterly thing that you do. But talk about it, be real with it. When you're doing a budget, I always say write it down, have it in an app, use a spreadsheet. Don't keep it all up here. Up here is great, but we get that little voice that starts talking to us sometimes. And when we see it on paper, it's a little bit easier for us to understand. Start saving, investing automatically. That's a very easy thing to do. With your job, always look at what your 401k is doing. If you get a raise, maybe you want to up what you're contributing to your 401k, because they take that money out pre-tax, and that can be earning you a lot of money. Every dollar counts. It starts adding up very quickly. And it doesn't seem like it when you're just $5 a week, but $5, that could be one less Starbucks a week that you're doing. And if you do that over the course of a month, it really does start adding up. And finally, this is our contact information. If you get off this webinar and you're like, I wish I had asked them that, or I have a question about this, whether it's investing or savings or any financial topic, please shoot us an email. There is no membership required to do that. Today, we are funding all memberships that are opened because everyone does get a savings account with University Credit Union. And then that QR is to make a virtual appointment with us. If you would like to speak with Lucy, send us an email and we will get that set up for you, and she can advise you on the investing part. We thank you for your time. We are going to stay on here a few moments and answer any last minute questions that come up. I'm going to check the Q&A here, see what we have. Julia, any last minute thoughts you want to add in?
I think the last thought I'll leave you with is what we're trying to get towards here is we want your money to be working for you. There's nothing worse than you go out and work hard all day long and you come home and see that your money has been doing nothing, just sitting on the couch watching TV, right? We want it to be earning and growing and working just as hard as you are. So there's a lot of different resources that can help with that. The investments we talked about, savings accounts, and the sooner you start, the more that money can work for you and help you reach those goals that you're already out there working hard to achieve. So if we can help you plan for those and get that money working hard alongside with you, we'd love to help. Go ahead and schedule those appointments, and we're happy to talk more.
Well, there's some great questions here in the chat. One just popped up. I may have missed it. Are FDI insurance the same at banks and credit unions? They're the same concept. Banks use FDIC, credit unions use NCUA. A little fun fact, NCUA has never been accessed ever by any credit union. FDIC has been. And so that's a nice thing. Your money is safe at a credit union. It's just a not-for-profit versus banks that have to pay their shareholders. So great question. Are limits the same? They are. It's 250,000 per account. Good question. I see the ones about being referred to Lucy. We will get that information for you. This webinar is also going to be on our YouTube channel. And so you can go back and access it and get all the information there as well. Again, we thank you for attending today, and connect with us on social media if you do not, because we will post future webinars on there and upcoming events that we do in financial literacy.